Hello, I am Lisa J. Stocks. Thank you for tuning into this week's Stock Talk episode. If you haven't already, give the live a thumbs up, chat. If you're not subscribed, subscribe, and let's get the show up to 75 likes today. Sorry. All right, so things are rough right now. I do have sympathy for those personally affected by this wartime, that your friends or family are deployed or things of that nature. But what we talk about here is how our finances are affected and how potentially things will look down the road 5 years after we go through the hard times that we are currently in. Kevin, I don't understand your comment. What is that? All right, so let's get into today's topic. And it is basically investing even through these rough times, just staying focused, not trying to time the market, turn away from our investing, staying consistent. And guys, let me know if you're able to, everything's coming okay, that you can hear and see me and everything. And Kevin, please let me know what that, when will you be able to afford a Lamborghini? Okay, Kevin, I can't help you with that one. You and your lovely girlfriend will have to figure that out together and budget and save and focus on getting that Lamborghini. So thank you guys for tuning in. Okay, I think everything is going well, and
thank you so much. We do greatly appreciate it.
Thank you, Vincent, for always being here to wish me a happy Sunday, and for that first super chat of the day. I appreciate all the support that you send to my channel. Okay, let me give it a thumbs up too. All right, so let's get into the topic. Let's get into it. Okay, so like I said, sorry for everything that is, not just financially impacting those out there, but let's get back to what we talk about here, and that is investing, finance, money, everything money related. So I've seen it myself. I was just on a, main street recently, and I'm on the East Coast. I know it's much higher always, it seems, over in California, but the gas price was $3.11. I was just over there last night, and the gas price was nearly $3.50. And it was just the other day I was over there picking up some food. And thank you, Chad. I appreciate that. And so I see that already. Rising fuel prices, as I've already mentioned, these war and political tensions, recession overall, it seems like it's here. And then there's concerns about bigger market corrections going on. And so it left us with 3 weeks in a row ending with the market being down. And markets move in cycles, but of course, we're going to be so much more heavily impacted with what we're going through right now. But I want to continue to have everyone stay calm. And I'm going to talk about this from different angles. I know we're all at a different place with what our investing journey is. At one point for many years, all I was doing was contributing to my 401k. So I'm going to start with that. For those of us that's what we've been with a company for some time now, we're contributing to our current plan. What we can do is continue to evaluate it and determine, be in tune with how much you can contribute. It's for I think it's about $24,500 for those of us that are under 50. So I know, working full time, that was plenty of a high enough limit for me to be able to contribute. My contribution was definitely less than that. So it's a high level, but figure out, what are you doing? Are you making strides to increase what you're contributing to your employer plan? And with that, have an idea of what you're on track to achieve. You can do that by taking what you currently have, putting it into the investment calculator, and whatever age you plan on retiring, put those numbers in. Check on that rate of return that you're currently getting, and make sure that you are getting a reasonable rate of return, that you're not an underperforming investment. If you are, make changes there. But you might want to use even 11% as an average to see what you're on track to achieve. Many people in their 60s on average have between 250 and 300,000. That is not enough. I was just watching a story, and this was on the news. This is not just something I saw on Instagram, so hopefully it's from a reputable source. It was on a Tennessee news broadcast, and so there was a 78-year-old man caught on someone's security camera delivering food at 78 years old, holding on to the railing tight, trying to get up there and, navigate the porch and put down the food, bending over to put down the food. Everything looked quite, intense and labor for him to be able to do this. He was making sure, I could see he just didn't want to trip. He's walking unsure everywhere he goes, somewhere unfamiliar, and he's just being very mindful of his surroundings. But the person wanted to find him and give him $100 tip or something like that. But they wind up getting into the news. And so the story winds up very well for him and his husband. No, not husband, him and his wife. He's doing this in order to get some extra money because they were running short every month just to manage those bills and their medical costs. So that's why he was picking up these Uber Eats extra added side hustle little jobs when he could. Message got out, and they wind up raising over $500,000 for this person. So I'm just sharing that as a story, but all of us are not this is not all, it's going to happen to all of us, that the GoFundMe is just going to go crazy and things are going to turn out this way. So back to us regular people, that I want us to be striving to take care of ourselves, because there are so many people in the same couple's situation where they didn't plan. Now they're falling short. They want to remain in their home. They want to remain, having their vehicle and the different things that they have, but they don't have enough. And so us regular people are those of you that are watching, that is your main focus, is just your employer plan. Make sure to see where you're at. Increase your contributions. Are you at least at 15% between what you are contributing along with your employer match? If you're already there, can you increase even higher? And because, like I said, below 50, you can contribute about 24,000. Above 50, they give you a little catch up once you get into that range, and then you can contribute up to 32,000. So are you doing this? Are you in tune with what you already have? What is on track to grow to, so that you have money put aside and you're not out here at 70, pushing 80 years old, still trying to earn a little extra money in order to take care of the essential things that you need. All right. So beyond that, I was saying that most people age 67, the average that they're giving is 250 to 300,000. But what suggestions of like Fidelity and at a minimum, I've seen that you should have 10 times your salary. I'm not going to even say what the average US salary is. I want you to think to yourself right now, what is my current salary? What do I think it'll be when I'm in my 60s? However, if you're close to it, it's easier for you to estimate. And then multiply that by 10. Are you on track to have that much in your investments to draw from in retirement? Because, as I've been mentioning over and over in my different shows, because these are things that I like to highlight here, your Social Security may not be very substantial. It's based on your lifetime of earnings or your 25 years of earnings that they're going to use to calculate what you're going to be receiving. And that may be as low as $1,400 or $1,500 monthly, depending on, what your career has looked like over these years. So I want you to just think about all of these things so that we're not here struggling, working. And, it's a very rare story that you hear of someone getting the whole amount, 500,000, that they should have been working to invest for themselves. It comes through for them through some great GoFundMe efforts. So we have to be, I just wanted to share that story. I've seen it happen a couple of times, but who knows how long they were struggling, trying to get those ends meet before that happened. And it's not going to happen for everyone. Okay, so everyone who has rolled in so far, have you given the live a thumbs up? If you're taking a second to do that now, please let me know what like number you are in the chat. So let me take a look. Eduardo, thank you for tuning in. I'm guessing someone shared me out in the Discord. I appreciate that. Do you invest in the US or do you do world VT? I do not invest. I do not invest into VT or VXUX. I think that those are quality investments. I just happen to have been I focused on the S&P and VTI when it comes to my core foundational investments. But I think that those are good options. And, depending on times like now that we're going through, could be even better options than the one that I chose. But I'm happy with what I've incorporated into my portfolio. And I'm right now, oil and gas and energy and international is thriving a bit more. But in time, I think things will shift back to the type of investments that I currently have in my portfolio, which are very tech focused, semiconductors, technology, the way that it has been for some time now. And plus, I do rely heavily on having those core investments that are going to rebalance on their own and always keep me heavily weighted into the top performing companies or the companies with the highest market cap. Yes. So I hope I covered you. Why do you not do international to diversify? Just personal preference. And like I said, when I got started investing on my own outside of my retirement account, it's just the direction that I went. But between, I do still have some target date funds in my portfolio. So I am getting exposure in there. It's just not as an individual stock, like you mentioned, VT. I don't invest directly into it, but I do have some funds that are very diversified. Like I said, I am in some target date funds. I usually push them out much further, even 20 years from my true anticipated retirement date, but it gives me exposure to everything that's out there. It's built in. Okay, so hello, Anthony. Thanks for tuning in. Okay, so I just wanted to start with that because I think I do a bit of it all, but I want to just have the conversations about all different aspects of investing. And for some of us, it is just that employer plan, but whatever we're working on, or whatever our focus is as far as our investing journey, I want to make sure that we're putting thought into it and seeing if there is any work that needs to be done or could be done. And so I touched on a few things here with, are you contributing up to 15% with or without your company match? And are you making strides to increase it? Now, let's touch on the Roth IRA. Now, that's something you can do additionally, or if you're like me and you've been laid off from jobs over the past few years or whatever time frame, you might have to then take control of older 401ks from those previous companies. Or if you work and it's not provided for whatever reason, they don't provide you with a 401k or 403b or something like that, then you can get in contact with a broker and do it on your own. No excuses, no gaps of time. If you're, looking for your next role, if you're working as a contractor or whatever the circumstances are, I want us to all be on track and striving to build for ourselves for our retirement. And so the Roth IRA contribution limits for 2026, $7,500 for us under 50 and $8,600 for over 50. So that's another place that you can build and set up recurring investments and deposits so that you're always staying on track. I happen to stay consistent with, contributing to my employer plan. And then also on my own, I create my own challenges so that I'm always building. And another thing I incorporate is setting limit orders in order to catch very low points. I'm not always trying to time the market. I do consistently invest, but there are opportunities. Just last week on Monday, I set a limit order and it filled on Friday while I was at the mall with my mom doing some shopping. So that's a way that you can build and not have to miss out on the opportunity that the market is presenting to us right now. So, like I said earlier on in the show, we have had 3 weeks in a row where I think all 3 of the indices ended in the red. So the market is coming down. We're dealing with all of these different things. And I touched on, I think I put a post on my public community wall about, the jet fuel is going up, the regular fuel is going up. And so that's going to trickle down everywhere, whether it's you have a vacation plans, but transportation in general is going to go up. Even the Uber and Lyft drivers, they have that built in that they're going to be able to increase their prices because the gas prices, like I've mentioned, have gone up at least about 40 cents in my area already, maybe 30 cents at least. And so with those things, it's just everything is impacted. I didn't realize until I was reading up about it how many things oil is even used to produce when it comes to even clothing and things like that, fertilizer. So it's going to impact all of our costs, whether it's groceries, whether it's the actual growing of the food, delivering the foods to the supermarkets, transportation as a whole. So this is what we're going through, and we have to be ready for these times. But I want us to take our emotion out of it and do our best to budget and stay consistent with trying to stay on track and not be shaken out of good positions, not stop investing because we're seeing even significant 5, even 10% drops when it comes to certain investments. This is the time for us not to panic. It's the time for us to stay consistent. If we are doing something outside of our employer plan, if we are just sticking to that employer plan, I'm encouraging you to take a look, evaluate, see if you can step it up there. If you're doing it on your own, the same thing. Push yourself to see what we can really do to increase and be on track to improve our financial outlook. Because if you're not even in tune with the numbers, like I was sharing, of having 10 times your salary invested by age 67, what you currently have invested, what is it on track to grow to? So those are the things. If you're not in tune with that, then you're not able to have a standard for yourself and be on track to build and grow and make progress. So I posted this to some of my channel members and things. I'm trying to look from my notes here. And yeah, here it is. So this is a little bit of a breakdown as to what the market looks like 5 years historically, 5 years after we're in the times like we are now with the war and all of the economic concerns that we're facing. And so 5 years after World War II, we were up 77%. I think the most significant one on the list here is after the Korean War, we were up 118%. Less significantly on some of the other time frames, but the Gulf War up 84% 5 years later. So we think about what the stock market has done just in the last 3 years without being under these type of circumstances. Now we think about the pullback that we're having, and with just the regular growth of the economy on top of thinking about the recovery of being in these post-war times, we have to just think about the big picture of what our portfolios could be on track to grow to by staying consistent, maybe even doing more. By then, we'll be 5 years down the line, we'll be into a different administration, and we really could be seeing our portfolios really thriving and back on track, even if we are going to have to kind of want to turn a blind eye to it, or not, never a blind eye, but you may have a little bit of tension looking at it right now, especially if it's a newer position where you're not that deep in profit. But I know it's hard right now, but I don't want anyone to panic, and I want people to zoom out, think about the future and what you really could have the opportunity to create by looking at times like now differently. I know, like back in 2008, I wasn't as in tune with my personal 401k. I wasn't investing on my own outside of that. So I just knew prices were rising. I was stressed. I was also a new mom of a newborn, and I wasn't seeing I was just worried about today. But now that I've been through that, I'm able to think back and reflect on it. I'm thinking about 5-10 years down the road. And so for those of us, which I think most of us are all in that age range, that we lived through that before, if you were looking at things differently like I was back then, let's just think about where we're going in the future and be on track to have things look differently this time around, and be able to take advantage of a situation that it's hard to go through, and it's tough to deal with in the now. But I'm thinking about the future, and so I did the same back in last April with everything that was going on with the tariffs and what was going, with all the back and forth with Trump and China and all the other countries that he was trying to impose all those different things on, and still feeling the effects of that. But I saw an opportunity then, I see an opportunity now, and I just want to share why I'm feeling differently, and just want to encourage you guys to never panic sell. Evaluate the quality of the investments. Not everything is going to recover, but that's why I want to always highlight that it's okay to stick with funds. You don't have to pick individual stocks. But like right now, I'm hearing, obviously we know that oil, even silver and gold, those things have been thriving, but think about the long term. If that's something that you want to incorporate, is that something that you want to build up your knowledge on and have in your portfolio, and that's working out for you, that's great. But I incorporate a lot of investments that are more diversified, that are going to just rebalance automatically and give you exposure to top companies and different sectors built in. So you don't have to necessarily put in the work and do the tracking and potentially have to cut those positions out of your portfolio when things shift and they're not going in the same direction that they are right now. So I say all that to say that I'm not disappointed that my portfolio doesn't have more exposure to energy or gas or those different type of things, because I just didn't have I didn't put the effort into wanting to hold them when they were not thriving, just so that I had that additional exposure when things came about like we're dealing with right now. So I stuck with more of a blend of those investments that kind of touch on all different sectors, but are more heavily weighted into tech. And I had someone recently make a comment about I've been sharing from time to time some different videos of what I'm buying, what I'm holding, like buy and hold. I usually title them, and I'll share a few of my investments, my positions that I'm holding for the long term, or I'll show you what I have an extra $60 today or an extra 50, what I'm going to invest into, what I'm going to build out into my portfolio. And so someone made a comment as to, well, you already have the S&P. Why would you then invest into Tesla or Google? And that's not diversification because they're already in the S&P. Yes, most of the companies are going to fall. Most of the companies that I'm going to invest into, or that are familiar to us, are going to be in the S&P 500, the top 500 companies in the US. I also invest into the total stock market. Don't need to do both, but I do have a position in both. And so I do it that way, and I'm here. This is my channel. I'm sharing my investing journey of what I'm actually doing. It may not be in line with what you guys want to do, but I did it that way so that I can have stability as well as growth. And with that, when I look and I share my different positions, my S&P 500 is not up as significantly as my Google stock or some of my individual stocks. But at the same time, I didn't want to go all in on all individual stocks and have to just stay on top of their performance and all of that, and be worried about the volatility that you're going to have to see in your portfolio when you're relying on those individual companies. So that's how I go about building. And yes, most every fund, most of the ETFs that I'm invested into, for example, SMH, which is a semiconductor ETF, as well as the S&P 500, or even my growth fund, which I'm working on right now, which is FSPGX. NVIDIA, for example, is a top name in all of those. And so it is what it is. It is the largest company in the US. It has a market cap of over 4 billion. I'm not sure exactly. I haven't looked at the lineup recently, but it's how I go about creating a portfolio that I'm comfortable with, that's growing across the board, but growth and stability and diversification is giving me what I need, and it has me on track to achieve my goals. And I definitely have goals. I definitely have standards, and I definitely have a bar as to what I always want to see going on in my portfolio achieving for me. And so, okay, let me just take a quick sec, guys. If you haven't already, can you make sure to give the live a thumbs up? I'm seeing 15, and there's been over 20 or 25 in the chat every time that I've looked up. Thank you, Miss V, for those jewels. And Let me take a look. And again, thank you to Vincent and Chad for those super chats earlier on in the show. Okay, so guys, if you're just taking a second right now to give the live a thumbs up, let me know what like number you are. And guys, I'm going to pretty much leave some time today for open chat. So if you have any questions, make sure to drop them, and I'll be taking a look at the chat from time to time. But I'm trying to make sure to keep up. You were like 15, Shanna. Thank you for the update. All right, so okay, I've been talking about it already, but I did meet with someone recently, and they like, I think we use certain terms like stocks and bonds. I'm not a person that invests into any bonds. The performance of bonds, I don't want to know anything about it. But as I've been touching on, for those, I always have to, I feel like I always want to just touch on certain things because there's always someone new, and we're all in different stages when it comes to our investing journey. So just want to highlight that we do not need to buy individual stocks. I'm doing a mix. I just touched on why I'm doing a mix. And if you don't think that that's the right direction for you, I hope that you're evaluating these things and really putting the work into finding the right direction for your portfolio. Because in my opinion, I want you to have stability. I want you to have quality investments that you don't need to worry about constantly. And I want you to be able to make it through these tough times like we're going through right now, and not have to be shaken out of good positions because you don't think they're going to recover. You have to have an understanding of the fundamentals, keeping up with the news, and realizing why your portfolio is being impacted in the way that most likely it is right now, because it is what it is. We're all seeing it across the board. But like I said, I want us to think long term and keep our minds on what things could be historically. 5 years down the road, 10 years down the road. We always have these things to reflect upon, and history does not always repeat itself, but using our best judgment, it's something to go by, just like with anything else. And so I want you to think about that when you may be feeling stressed about your portfolio. And remember that it's an unrealized loss until you sell it at a loss. Just like my gains that I share in my videos, I don't every time, but they're unrealized gains because I'm not taking profit. I'm not cutting these positions from my portfolio right now. But what I'm doing is I'm staying on top of those investments. I'm taking the time to go into my investment apps and the resources that I have, and doing the research to say, okay, should I add more to my meta position, or whatever it may be, whether it's an ETF or an individual stocks, meta, for example, and taking a look at what are the price targets, what is the anticipated as far as the growth of the company, looking at those fundamentals, and then seeing what Mag 7 stocks am I holding that are on track to have 20-30% additional upside in a certain time frame. So I know that I'm okay to continue building and holding. And so that's how I go about knowing what I want in my portfolio. And then if there is something that is underperforming or more speculative, which most likely I have almost none of that in my portfolio, I can then know what I want to do in order to manage that, potentially putting on a stop loss, or putting on even one that's, if I have been holding it for some time and I do have a substantial amount of profit, just making sure that it's something that if it's time for it to potentially be on track or, getting close to being cut from my portfolio, that I let it go before I'm in a position where it's down and it's something that I don't want to wait for it to recover. But many of the positions that I'm holding as individual stocks are those blue chip names that we've heard of, smaller positions in, for example, Netflix and Meta, which I've already talked about, but I want to have more exposure to some individual companies like Microsoft. And so I share updates on those from time to time on how I'm going about building and whether I'm in the red right now and I have to give it time to get into that stage of being profitable. I share the good and the bad. So but I'll tell you, because I've been at this for some years now, the good outweighs the bad substantially. So I'm okay with that. And thank you, Invent Yours and Jay Jordan and everyone who has tuned in recently that I haven't had a chance to say hello to. Okay. So these are just things that I just wanted to touch on because I don't want anyone to be stressed out about what we're going through. Just focus on understanding the news, focus on understanding the potential when it comes to the opportunity that you may have when it comes to building up your portfolios, even if it is just increasing, making sure that you're staying consistent with your employer contributions. And I was thinking about, there's so many different things that you can do as far as, investing for your children, having a taxable brokerage account in addition to your 401k and your Roth IRA. I am a part of Keenan Grace's Discord on an almost weekly basis. I do options trade also. So these are all different things. And you have to think of it like as though you were a new driver. I'm still trying to get my daughter to the place where she's driving and, she hasn't gotten her license yet, but she needs to practice to park and get a handle of things. So right now she's still in that stage where we're not going on the highway yet. We're working on the streets and residential areas and trying to work on parallel parking, but it's a matter of finding that right place to work on these things. You're not going to jump into driving just like you're not going to jump into investing as though you're going to be able to parallel park on the left-hand side of the road and get up on the highway and drop somebody off at LAX or JFK. Because those are things that you need a higher level of skill for. And so with certain things that we work on, we know you have to take it step by step. And so some parts of investing, I kind of jumped in and we're trying to do things that were a little bit out of my knowledge. But now I've built up my knowledge and I just want to encourage you not to let anything hold you back when it comes to investing because you can get there, whether it's, understanding and being patient with having a position when it comes to crypto, choosing those individual stocks that fit your goals and long-term plans and outlook that you want for your future. You can do it. You can do it, but just take it one step at a time and use the resources that we have to research. And like I said, put on a stop loss. You may not want a certain position to be cut from your portfolio, sold in less than a year's time frame because of the tax implications, but put thought into the whole process before you incorporate it, because I don't want you to be stuck diamond handing something that is potentially not going to be recover. And I definitely don't want something like that to occur and turn you off to investing as a whole. I just want us to be on track. That's why I said that I need to have both stability and growth when it comes to my portfolio. I couldn't be so heavily weighted into individual stocks or crypto that my portfolio was having drastic swings and had me worried for long time frames as to when things were going to pick up. So I'm more of having a balance. And so, like I said, I think I do a little bit of it all. As far as I'm a little bit, mostly a high percentage of investor, very small percentage trader, but it's okay to lean into investing into ETFs and mutual funds. In my opinion, if you're getting started or across the board as your whole investing journey, but I want to make sure that you're putting enough money into them and not not being and understanding what you are invested into, because yes, they are built in. They're a way of easily investing. They're a way of having that built-in diversification, getting exposure to hundreds, even thousands of different names in one investment choice. But they are not all equal. So some research needs to be put and effort needs to be put in there too, to make sure that you're not in a SPY, for example, that has a 0.9% expense ratio, where there's no reason to invest into that when there are many other investments that give you exposure to the S&P 500 for 0.03 or less. Why do we want to go to the choice that is 3 times more? So I don't want anyone to be intimidated. We can all do this. Investing is for all of us. And I always talk about my daughter, my youngest daughter, because my oldest daughter, she already knows. My youngest daughter, I just really want her to know that it's about making your money work for you and seeing that your money is not going to grow if all you do is just focus on paying rent and eating out and buying a car and paying the car insurance. Those are not things that are going to have you on track to build wealth, to have your money making more money. And so I want to instill in her that you need to always be taking a portion of your money and investing it and letting time pass and seeing 25% gain this year, another 25% the next, and so on and so forth, and making good choices and not always looking to your investments constantly to take profit. Give them a chance to grow and let that compounding do its work for some time. It's not, it's not trading. Trading and investing are two different things. And so it's about the money mindset, thinking long term, and I've made this talking about the fees of the mutual funds and ETFs. That's an important place, but I've also been, evaluating lately, lowering fees everywhere when it comes to my finances, or cutting things out completely that I don't feel are giving me that benefit. And I'll share a couple of those, and you guys can share in the chat if there's any that you've evaluated or eliminated from your budget recently. So one thing that I did was I turned off my XM radio in my car. I haven't been really driving long distances, and I tell you, I really use sometimes when I'm in the car driving, whether I have someone with me or not, because sometimes my daughter will be listening to her own thing, even if we are in the car together. I use my time in the car a lot to support other YouTubers and check in on different podcasts and things like that. So I really wasn't feeling like it's worth the cost of having the XM radio. So for her right now, that's eliminated completely. Another thing I'm doing is just evaluating my subscriptions, my Wi-Fi plan and things like that, even my cell phone plan, and seeing what each line item, what each package includes. And I've been able to save some money there. And there's certain things maybe you're not thinking about it, but just by getting on the phone and having these conversations with a representative, they'll be able to highlight and paint the picture for you. For example, with the cell phone, I happen to like and feel like I need to have the availability and the feature of having a hotspot in order to use my phone to run the computer off of, or another phone off of, because it's a feature that I actually use when I'm out and about, or um, when I did lower my plan and that was eliminated, it's something I actually noticed and was like, what is going on? But I asked my daughter about it and she was like, no, I really never use that. And I think that costs a few dollars per month to have that on the line. So it's somewhere that you can save money. So Dr. Ninja, Daryl is sharing that I paid for a lifetime subscription to XM 20 years ago and have not paid. They are losing money on you. Okay. They sure are. And when I turned off my service, of course, when you turn off your service or you contact them and tell them you're thinking about it, they always pop up with some special, even if it's for a year. They're always wanting to offer you something in order to keep you on. Almost always, I've experienced that they are going to get you in contact with someone in some retention department and try to give you a special. If it's not permanent, then it could be something that could give you a year or a year and a half at a lower rate. And so it could be the incentive or something that you're willing to keep on. And then after that time frame, call back again and see if they'll work with you. But it's just a way of just going across the board of your finances and making sure that there's no hidden things that you could be putting to better use when it comes to your portfolio. Because I know it's rough out there. I was in, I think, Rod's live, someone's live recently, and they were saying that they had spent $400 in Costco, someone in the chat. And I said, I spent $400 when I went to Costco also. You're not alone. So I definitely know. And I try to stick to, I went to Walmart also recently. I'm trying to stick to going to what I know to be the low cost retailers for as much as I possibly can when it comes to basic items that I'm going to need to keep my household going, as far as laundry detergent, paper products, and things like that. So I'm trying to buy them in bulk, trying to buy them from the low price, the places that have those good prices. And I'm still spending a significant amount. So I know how it is, but I'm just trying to make sure to prioritize saving money there, getting my money invested as much as possible, and just moving forward with staying on track to achieve my goals. So, good afternoon, Jody. How are you? I don't use XM much in the car, but I have it on my motorcycle. Okay. Yeah. I mean, I enjoy, I can't even, I enjoyed that the quality of it, that it always worked. There was no, staticky or anything like that. But I really just had one favorite channel, which was Rock the Bells radio. So it pretty much stayed on that all the time because that station would play what I really enjoyed. But I'm going to figure it out for now. I haven't turned it back on. Okay, so guys, drop in the chat if you have any questions. I'm going to jump over because I did put up a poll question. Let's see if we got any votes on the poll question. And make sure if you haven't already, give the live a thumbs up, drop your questions. Let me take a quick look at the poll question if I'm able to find it. Let's see. All right, so let's take a look at the poll. And it says, do market headlines affect your investing? So 43% said yes, and 57% said no. I'm going to end the poll and let's see if we can see the results here. Yes. Okay. Let me go back. Something seems to be wrong with YouTube. So I wonder what that means to everyone. The market headlines are affecting your investing. So is it affecting it in a good way or in a bad way? For me, I would say it affects my investing, but I'm turning it into a positive in the way that I'm allowing it to affect my investing by, like I mentioned earlier, setting limit orders, investing more heavily, not necessarily, being rigid to try to time the market perfectly, because I think that by doing that, you could let time pass and something just keep going up and up and up where you thought that you were going to be able to catch it on a certain dip at a certain price. So I stay consistent, but I also mindful, set alerts for investments that I am working on building up, as well as pairing that with those limit orders. So all of those are my ways of being on track to use the headlines to positively impact the journey that I'm on as far as I'm investing. But I hope that those of you who said that the headlines are affecting your investing, that it's not in a negative way, that it's making you not want to invest, because like I've been trying to highlight throughout today's show, that if it is a good quality investment, if the fundamentals are still there, and this could be an opportunity to build for the future at, at a discount because of just everything that happens to be going on as far as the economy. So think about it that way. And I know a lot of us are being impacted by layoffs and the changes that are going on in the industry and technology coming along and disrupting our careers. But one thing that we can take control of is making sure that we're adding assets to our portfolio and staying focused for the future, and making sure to, like I mentioned, this is a big thing that has really made a huge improvement in my financial outlook, is taking a handle of my 401ks from the previous job to make sure that they were on track and maximized and growing to their full potential. And they were not going to be if I did not go and move them and get them growing over in my portfolios, which I have been building for retirement over at Fidelity. So Shannon is sharing that I transferred an old 401k into a Roth IRA. It's about $22,000. Would you invest it all at once, or would you DCA your buys over a certain amount of time? And what would you buy? Okay, Shannon, I often get this question, and I have been through this process. I closed an account at Empowerment, and I transferred it over to Fidelity, and I then had to get it reinvested. I took too long of a period of time to invest it. You have 22,000. I would, just so that you don't have to feel like you jumped in all at once, I would set a pretty short time frame on getting it invested, like we've been touching on, and we are all aware with the economy the way it is right now. I think you could definitely get that done in maybe 6 to 8 weeks, get that invested. If that's something that, if you want to just jump in all at once, I often try to, like, when I'm meeting with people, say that this is us partnering to come up with the plan that is right for you. There are different scenarios and different ways to go about it. I would suggest you go about it rather quickly, because I don't think that that's anything that you need to hold on to. And maybe just keep a little bit if there is anything that you think that you may need for the second half of the year. We only have 2 weeks left for this first quarter of the year. So I think you could definitely get that invested before we get to the mid-year, and just reserve a little bit if you do think there's something that you'll need for later on in the year. Now, cash is not king. Holding on to money is not you're only going to be getting 3%, 3.5% while you're holding on to it in cash. So think about the long term. Think about, just getting it into the market and getting it working for you would be my suggestion. But you have to do what you're comfortable with. That's how I would go about it if you don't want to just jump in and do a whole, lump sum investment. Now, as far as which you should invest into, that depends on your age, your risk tolerance, and the direction that you want to go. I often will mention different investments. I'm not really focused on investing into high dividend payers right now. I figure I can shift into that a little bit later in life when I'm ready to be in more of a preservation stage when it comes to my portfolio. Right now, I'm focused on growth. And so a few investments I'm doing, and like I said, it's not a one size fit all thing. If you're closer to retirement, then I wouldn't be aggressive. I wouldn't be focused on growth. I would be, like I said, thinking about the preservation stage. I'm going to be drawing on this because there have been stretches of time when the market was on, say, even a 3-year downturn. We just saw a significant downturn in 2022, but then we saw what followed the 3 years after. But build from there. I build a core foundational investment like the S&P or total stock market, say, 40, 50%, whatever you're comfortable with there. And then I bring in different funds. I also do just a select amount of individual stocks when it comes to my IRA, because I want to stay on top of those and not have anything in there that I don't think is on track for long-term growth. So some of my IRA investments are into, I do have some target date funds. I don't love them because I think you have to really take a look at them to find the right fit, but I do incorporate those, but they have to be significantly outside of my normal retirement date in order to give me the blend that is on track with the performance that I want. So I use one that's, say, 20 years beyond my age in order to be heavily weighted into into stocks as opposed to bonds and other things. But you have full flexibility, so you may not even want to go there. Overall, I do core investment, like I'll use Fidelity funds for an example. FXAIX, that's my S&P at 500 investment. FSPGX, that's my growth investment. Some other things I've been incorporating are SPMO, which is a momentum ETF. SMH is a semiconductor ETF. But with that, that's a particular sector that I wanted exposure to. You can choose a different sector, like we've mentioned, if you want energy or healthcare, or there's a particular sector that you have a high conviction in, you can find the right ETF for that. But I would go heavily into finding a mix of different ETFs with low expense ratios so that you're not getting your, don't want you to see you ever getting eaten, your gains being eaten by fees, and do a mix that way. So depending on what you want, if you want dividends, a DGRO, or depending on what broker you're with, there'll be different options at your broker. But I would do a mix of core, growth, dividends, sector specific. And then if there are some individual stocks, you could mix those in too. So guys, let me know your thoughts on the thing that I'm sharing on different investments for an IRA. And two individual companies that I do hold in my Roth right now are NVIDIA and Taiwan Semi. So, but I'm going to keep it pretty limited to what I'm incorporating as far as those individual stocks. But I think you can do a lot by just mixing some good ETFs and mutual funds and create a portfolio that way. But I would say as a bar, maybe you want to take a look and say, okay, if I'm going to go maybe beyond, maybe to start with, if I'm going to go beyond 0.15 or 0.2 as far as an expense ratio, I'm going to put some extra effort into taking a look at the performance and really thinking, is the performance worth the fees? So just a little something extra added in there just to give you something to think about. And so you said you are at Fidelity too. Yeah, I love Fidelity, but you can get caught up with some high expense things there. So there's a mix of different ways that you can go. And it doesn't even make sense to me that these brokers have some of these funds that have these high expense ratios when they have a better fund. Like I believe VOO and the SPY, are they under the same broker? Are they under the same broker? Well, they're okay. I know this one is for sure. QQQ and QQQM, same company, same tracking, same, tracking the same group of investments. Why do you have both of them when QQQ has an expense ratio of 0.20 and QQQM is at 0.15? Why not eliminate the higher one why create a lower one and keep the higher one? And so many people may still be investing into the higher one because they don't realize and they don't know better. So I say all that to say that make sure you have your eyes open to all of these different things. And let's take a look at the chat. Hey, Jay Jordan, are you saying goodbye? Are you saying hello? Thanks for tuning in today. Thank you, Daryl, for the time that you spent here today. I hope you enjoyed today's conversation. Again, thank you to Chad and Vincent for the super chats of today. And let me take a look back at the chat. Guys, drop any questions that you have. And let me know how you enjoyed today's conversation. Let's see. I have an ETF or mutual fund. I have mostly index funds in my account, VOO, VTI, and VUG. Okay. So VOO, I'm using FXAIX at Fidelity, same S&P 500 exposure, but FXAIX has an expense ratio about half of what VOO is. VOO is at 0.03 and FXAIX is at 0.015. And then between VTI and VOO, there is an 88% overlap between the two. So you can definitely focus on just building up one. And I would say historically, the S&P has been slightly higher. So that one. And when I say slightly higher at times, I think I've seen the difference be like 1 or 2%, but it does seem to outperform a little bit. And then VUG is similar to the growth fund that I'm using at Fidelity is the FSPGX. So you can definitely take a look at some more or consider if you want to. I don't know how much you still have to invest. If you want to shift to those mutual funds, if they're going to be in an IRA, they might be a little bit more cost effective for you. Because I think I think FSPGX might have I think that and VUG the expense ratios might be similar, but you can take a look and, maybe incorporate something else for additional growth or dividends, a high dividend investment. I know another one that I've been seeing a lot of. I don't have it in my portfolio. I think it's FDVV, a high dividend investment at Fidelity. So maybe something you want to incorporate a few thousand too out of your 22 or a smaller percentage. All right, so I'm not seeing any questions. Thank you guys for tuning in today. If you haven't already, please give the live a thumbs up. If you're interested in opening a taxable brokerage account, check out my referral link for MooMoo. Right now, we're still giving a 8.1 APY on your uninvested cash. You get that for the first 3 months of opening up your account. So check out my referral link for that. And like, subscribe, hit that notification bell, hype my videos. If you check out a video during the week that you enjoy, don't forget to do that. And also, I am a Crown Trader over at Keen and Grace's Discord. If you have an interest in learning about options trading and, increasing your knowledge in different ways, and you can go ahead and check out my referral link and consider joining that Discord. So thank you guys. And I will be back next Sunday and every Sunday, hopefully at 3 p.m. Eastern Standard Time to continue with our different Stock Talk episodes. We talk all things money around here, and I appreciate all of your support. So let's wrap it up for today, and I will see you next week. But always be on the lookout for my videos, shorts, and content. Take my, do my votes and my polls on my community wall throughout the week. And I will sometimes have some additional pop-up lives, but always look out for me on Sunday afternoons. And I will see you soon.
And to investments, she made a lot on YouTube. Lisa J Stocks. Lisa J Stocks, that's the channel. Hey. If you wanna make some money, visit Lisa J Stocks.